नमस्कार सभी को. Let's continue the topic Basic Concepts of Economics Part 3. Here I have taken few more terminologies which are very important and vital from the economics point of view. So the ninth one, because in the last previous videos I have covered from terminologies 1 to 8. In this video I will be resuming from ninth. So national product. To understand national product, you have to understand what is the gross national product and net national product. So national product is something the total value of goods and services produced by all the producers in an economy in a given year. Now this given year can be a period of 12 months. If you know that 12 months can be divided into two types, like a financial year and a calendar year. Financial year which starts from April 1st and ends on 31st March. And likewise, calendar year starts from the 1st January and ends on 31st December. So whatever the value, see the value, that means when I say value, that means the goods and services which are being produced can be measured in monetary terms, in money terms. So whatever the total amount of goods and services produced in a accounting year, that is called gross national product. To get net national product, we should divide depreciation from gross national product. To calculate net national product, what is the formula? Gross national product minus depreciation. Now what is the depreciation here? You see, when a producer uses capital goods like machinery, okay, and many more things like capital goods. So what happened over the period of time? The machine or the capital goods value decreases because of constant usage, wear and tear, and obsolescence. Obsolescence means being machines getting outdated, right? So obsolescence means getting outdated. So because of these reasons, constant use, obsolescence, that means outdated, the value of the capital goods decreases. So to understand how much actual amount of goods are produced, we should deduct depreciation from the gross national product, because gross national product gives you the value of total goods and services which is produced in an accounting year, in a given year, in monetary terms. In that we deduct depreciation, because depreciation is not a production, but depreciation is a factor which happens because we are constantly using a machine. So whatever the losses incurred on machine is termed as a depreciation. So we deduct all those losses or depreciation from the gross national product. So this way we get the actual net national product. Then 10th is national income. How to calculate national income? See, sum of all incomes earned by citizens of the country. Citizens of the country, that means they should be the resident of the country, those who are residing in India. Whatever the products, whatever the goods and services, or whatever the incomes are being earned by all the residents or citizens of India, are, when they are summed up, when they are totaled, then it is called national income. You see national income, if you see the formula here, in the last I've written NI is equal to NNP at FC. That means national income means net national product at factor cost. Remember, when you add all the goods and services, monetary value of all goods and services, you will get GNP. From GNP you calculate NNP. How to calculate NNP? When you deduct depreciation from gross national product, you get NNP. Remember, this net national product which you found after, which you calculated after deducting depreciation, it is at market price. National income means net national product at factor cost. That means to calculate NNP, you know that deduct depreciation from GNP, you will get NNP at market price. But how to calculate NNP at factor cost? Factor cost means there is no addition of any indirect taxes. So if you deduct indirect taxes from net national product at market price, you will get net national product at factor cost. NNP at FC means net national product at factor cost. How to get NNP at FC? The formula is when you deduct net national product at market price minus indirect tax, you will get NNP at FC, which is equivalent to the national income. So national income is the pure income where there is no indirect taxes included, there is no depreciation, it is only the actual amount of goods and services produced. Because depreciation, why we are deducting depreciation? Try to understand. Depreciation is not an income for any producer. In the same manner, indirect tax is also not the income. Right? Here we are focusing on actual amount of goods and services produced in an economy. So indirect taxes is not produced. In the same manner, depreciation is also not produced. Therefore, these two are deducted. So you remember, let's have a little revision on this. How to calculate GNP? GNP is sum of all the goods and services produced in a country. Now, NNP, GNP minus depreciation gives you NNP, which is that market price. That means in that market price, indirect taxes are included. But to calculate national income, we should deduct indirect taxes from NNP MP. That means net national product market price minus indirect tax gives you net national product at factor cost. So if you get net national product at factor cost, then it is said that this is the value of national income. Then next is per capita income. Per capita income means, per means one individual. Capita income means one person, one individual's income. So how to calculate? If you divide total national income, which we understood how to calculate in point number 10. So division of national income by total population of a country, you will get per capita income. That is the formula. Then next is market. So market is any place where buyers and sellers are meeting. Why they are meeting? To do the trading. What trading? Selling and purchase. Now market can be a vegetable market, it can be cloth market, or it can be share market. Remember, the common factor which is happening here, it's exchanging the goods and services for money. So here two parties are meeting, buyers and sellers. Now what are the functions of a market? So when we talk about functions, there are only two functions: to determine price and to determine quantity to be bought and sold. That means, you see the diagram over there. There is a x-axis and there is a y-axis. On x-axis it is quantity and on y-axis it is price. So you will see there are two curve. One is going upward, which is quantity supplied QS, and another one is going downward, which is quantity demanded. That means this is a demand curve. You see, supply always has a upward slope and demand always has a downward slope. So when these point meet, that means the point of intersection, when they are cutting each other, that point which is been shown with capital E. Here E is the equilibrium point. What is the equilibrium point? Where quantity demanded becomes equal to quantity supplied. So this is a price which is the determination of price, which is the main function of a market. This price, that means the price which has been found after intersection of quantities of demand and quantity supplied. This is the main function for which a market is established, to determine the price and to determine the quantity goods are sold. So at price OP, you see, at price OP you can sell OQ goods, right? OP means the price, P for price. So OP price, at the price OP, at max a seller can sell OQ quantity. So market main function is to find out the price, the point where we can define at what price and at what quantity goods should be bought and sold. So this entire phenomena or this entire methodology is called market mechanism, where market mechanism is interaction that fixes the price and quantities bought and sold of all goods and services. Let's have a revision. Market mechanism or function of a market, where buyers and sellers meet together to understand or to find a price where both are mutually agreed, that at what price and how much quantity should be bought and sold. So at what price and how much quantity to be sold, it is only at that price where demand and supply are meeting each other. That means at the equilibrium point. Equilibrium point means where quantity demanded becomes equal to quantity supplied. And as per this diagram, it is OP. That means O till P, right? P for price, that much price for OQ quantity. Then the next is money, which is again important. Money means anything which is widely accepted as a medium of exchange of goods or for settlement of debt is called money. So money is a universally accepted or legally accepted legal tender which is produced or which is given in order to exchange goods or settlement of any debts. Now what are the functions? So first is medium of exchange. Remember, money acts as a medium of exchange. With the money, you can purchase the commodity you required. Medium of exchange is important. Why? Because you see what happens earlier days, barter system was in existence. Barter system means when you exchange one good for another good. So why money is a medium of exchange? You see, if I want, if I want say for vegetables, but the person with whom I'm dealing, that person is having rice, so their medium of exchange fails, because what I desired, the commodity which I desired, do not, it's not possessed, or it is, that person is not having that my desired product. So in this way the barter system fails. So here money becomes easy medium of exchange, where I can go and pay money and get my desired product. So here money, it is acting as a medium of exchange. Then there is a store of value. Store of value means, that means, have, if you know that with that money, if you saves money, you can save it for the future income. Like if you do the fixed deposit of that money, you will get some earning in future. So that store of value represents that you save today's money to getting income in future. So that is a store of value, which is not possible in barter system. You cannot store goods for, because of some certain expiry date or some certain constraint. You cannot store the goods, but in money you can store the value of money. If you store money, that means if you fix money, say for 50,000, if you make the FD for 5 years, definitely you will get the increased amount after 5 years. Then there is a unit of account. So unit of account says, it is easy to, it is very much easy, to calculate the value of goods in terms of money. For example, if I give you an example, uh, clothes can be bought in meters, right? Liquid things can be bought in gallons, or right, and for the grains you use tons. So these are the units measurement. But when you calculated with the money, these all different units of measurement can be brought down into a common measurement. You got it? That meter, how much, if you are purchasing 1 meter cloth, say for it is for 50 rupees per meter. So if you want 2 meter, by calculating 15 to 2, that means 100 rupees you have to pay. So what I'm trying to explain you, different measurements of units are available here, but with the money it becomes easy to uh, express the different units in a same or in a common measurement. In the same manner, if you want 1 liter of petrol, right? 1 liter of petrol, say for costing 100 rupees. Now if you want 2 liters petrol, it becomes easy, 100 into 2, 200, that means you have to pay 200. So it becomes easy, although the measurement units is different. For a cloth, measurement unit is meter. For liquid, measurement unit is liter, and sometimes gallons if it's in a huge quantity. So with the money it becomes easy to express in a common measurement unit. Then standard of deferred payment. So standard of deferred payment basically says that future dates and transactions can be settled with the money. Say for loans, you, there are certain contracts which are being completed in future, right? Contracts or loans, you took loans here, today you took the loan and you repay after 5 years. So this is standard of deferred payment. That means you are doing the settlement in future date. So money gives you that facility that you can do the settlement in the future date. So this is the features of money.